Anyway, going back to the phones, Ross is calling from Houston, Texas. Going to talk a little bit about interest rates and inflation. Ross, welcome to the show.
Yeah, hey, Peter. Thanks for letting me on the show. Just to start off with, I've been reading your book right now, and it's an excellent read so far, so good work with that.
Thank you.
Yeah, also, I also uploaded your debate with Nick from Wednesday to YouTube, so it's gotten some hits so far, and I've been having some good conversations with people about that, which is always really enjoyable because, you know, when I argue that, of course, production has come before consumption, one guy says, well, why don't you go produce a bunch of stuff that no one wants, and I'll laugh when you go bankrupt. And, of course, I responded, well, it's the entrepreneur's job to assess the market and decide what should and should not be produced, and not the role of the government through subsidies. And, you know, he didn't even have a response to that. So.
Yeah, and, of course, that's the risk the entrepreneur takes, right? He's trying to produce things that people want. But you know what, though? What happens is, let's say you produce something that nobody wants. What happens is the price comes down, and at some price point, everything is going to find a buyer. Right, so it will be consumed. Even if I make something that nobody wants, if the price is cheap enough, people will use it. I mean, they might not even use it for the intended use that I originally had. I remember I used to joke about, you know, the Beanie Baby when there was this bubble in Beanie Babies and everybody wanted to buy Beanie Babies, and I said, look, eventually, you know, no one's gonna want them anymore, and everybody's got all these Beanie Babies, and then, you know, and I read an article where someone said they make great insulation. You know, for your house. You can actually stick them in the walls and they work as insulation. Because obviously if the supply of Beanie Babies is great enough and nobody wants them anymore, the price could come down to such a low point where now it makes sense to find another way to use them. You know, which is what my reference to U.S. currency one day being potentially used as toilet paper. But the problem is it's not that soft. But you never know. I mean, if it's cheap enough, some people who are poor enough might decide they could use it for that purpose.
Yeah, there you go. Anyway, so my real question was the connection between inflation and interest rates. Now, obviously, the common sense response is whenever there's a lot of inflation, people are going to fear the devaluation of the currency, and so they're going to charge an inflation premium through higher interest rates. But at the same time, I also understand that interest rates are determined by the supply and demand for money, and so when there's more money, there's a greater supply. So that would almost seem to argue that interest rates would be coming down. So how do those two forces balance?
Well, it's basically it's more of a timing. Initially, as the Federal Reserve creates inflation, which it does when it prints money, and then it uses that money to buy bonds, that demand for bonds brings down bond prices or brings up bond prices, as they buy the bonds. So interest rates come down. So initially, as you create inflation, the act of creating it, to the extent that the newly printed money is used to buy bonds, government bonds, that the inflation brings down interest rates. But ultimately, that inflation, as it works its way through the economy, starts to show up in a rising consumer price index. And as other private buyers of bonds see that inflation and anticipate it continuing, then they are going to demand a higher rate of return for buying those bonds. So assuming that now you need private buyers of bonds, now that the Federal Reserve has created more inflation, now bond buyers are going to want to be compensated for that inflation by demanding a higher rate of interest. So in the short run, creating inflation can bring interest rates down. In the long run, it pushes interest rates up. Now, what happens to real interest rates, that's a little bit of a different story. I'll cover that when we get back, so hold on. We will be right back after this break. This is Peter Schiff. I was talking about interest rates and inflation before the break. The caller I had actually dropped off, but I want to just expand on that question before I go to Chris, who also has a follow-up on inflation and money velocity. But the real interest rate is another part of the equation, because as you initially create inflation, you bring down real interest rates, right? Especially for the loans that already exist. Because if I'm creating inflation and let's say money is losing 3% of its value, and if interest rates are 4%, well, the real rate of interest is now only 1%, because you're not really paying 4% when you borrow money, because when you pay it back, you've paid back money that's 3% less valuable than the money that you borrowed. So, and of course, the longer the duration of the loan, the bigger the impact of inflation on the loss of purchasing power. So as you initially create inflation, you bring down real interest rates. But as the market has a chance to react to this new information, see, once people believe that there's going to be more inflation, then they will demand a higher risk premium for holding bonds, particularly bonds of longer maturities. I think part of the problem, or part of the reason that rates aren't higher now, and a lot of it has to do with the Fed printing all this money, but there still is a general misperception out there that inflation is not going to be a problem, that inflation is contained. So the Fed has done a good job from its perspective of containing inflation expectations. Now, I believe those expectations are wrong. I think that people who are loaning money on the expectation that there's not a lot of inflation, they're wrong. Just like people who loan money to Greece expecting to get it back. They were wrong, right? Greece's creditors made a mistake because they already got a big haircut. A lot of people who were loaning money to home buyers, right, they were wrong because they didn't get paid back. The loans went in default. So a lot of times borrowers can get a mistake. They can misread the economic tea leaves. And I think that's what they've done. But once they get bitten, once they're surprised and they end up losing all this money due to inflation, they will be more leery and less trusting in the future of government promises to maintain inflation. And we're going to see huge increases in the inflation premiums. In fact, if you look at what happened in 1980, when we had Paul Volcker, the reason that Volcker had to raise interest rates all the way up to 20% was the inflation expectations were already were baked into the interest rate yield curve. People were expecting inflation to get worse, and what he had to do was to break that psychology. Volcker had to prove to the market that the Fed would not allow inflation to get worse, and we actually had the willingness to put rates up to 20%. It wasn't about bark. It was about bite. And that bit pretty hard. And that broke the inflationary psychology. And we're going to have to do that again. The problem is, how are we going to do it? Because the U.S. economy is now so levered up that how are we going to put bite in the Fed's bark? In fact, I think more and more people are going to call the Fed's bluff. They're, eventually, hey, you're going to fight inflation? We don't believe you. You don't have the cojones to fight inflation, because you know what that means. That means big increases in interest rates, and that means bank failure. That means unemployment. That means the government has to default. That means all these bad things are going to happen in the short run, and we know that you guys don't have the stomach for it. But that is, what we've got to look forward to.